right, everybody, welcome back to In-Person Macro. Thank you for bearing with me through my my quarantine there. So I obviously got a clear bill of health and excited to be back here. So let's go ahead and finish up Chapter 6, maybe start Chapter 7 today. Otherwise, we're going to go ahead and push Chapter 7 to be due on Wednesday. All right, so last time we talked about CPI, we talked a little bit, we did some calculations of it. So let's, as a review though, do some more calculations. So we're going to once again, let's get some lined paper. That's fine. All right, so we've got 2010 spending. And in 2010, we are assuming that, we've got rent of a 2-bedroom. We've got hamburgers. We eat 60 of them a month at $2 a pop. Got movie tickets. Again, we got 10 of those at $6 each. Now we have sweaters. We're expanding our bundle. We're buying 4 sweaters at $30 each. And so when we add all of this up, so we need some information about our rent. We're told that it's $750. And so then the rest of it, we do 60 times 2 is 120. 10 times 6 is 60. 4 times 3 is 120. If we add all these things up, we end up with $1,060. And then if we look at our 2010 spending, or sorry, 2015 spending, we see that our rent has increased. For a 2-bedroom apartment, the rent instead of $750, it's now $945. We are eating the same amount of hamburgers, and they have gone up in price to $2.50. We are seeing the same amount of movies, but it's gone up to $7 5 years later. And we're buying the same amount of sweaters, but the price of sweaters has gone up to $50. So once again, we got to do a little bit of calculation stuff, right? 60 times 250 is going to give us $150. 10 times 7 is going to be 70. 4 times 50 is going to be 200. We add all these things up together, we end up with $1,375. Since we're assuming that this is the bundle, this is the typical thing that people are buying, we take these total expenditure, these total monthly expenditure amounts. So and same thing here, this guy's monthly expenditure. So in order to get the CPI, the Consumer Price Index of 2015, with a base of that 2010, we would literally just take this monthly expenditure amount in 2015, put that in the numerator, take the monthly expenditure amount from 2010, put that in the denominator, and we end up with a CPI of 1.30. So that's telling us on average, given a certain amount of goods and services that we're buying, the prices have increased by 30%. So a CPI is an example of a price index. So a price index is defined as something that measures the average price of a given quality of goods and services, and that quality is going to come into play here later. Or sorry, this should be quantity. The quality is actually one of the issues. That's just a typo in the book. Relative to the same goods and services in a base year. Right, and that base year, for our purposes, is going to be 2010, just by default. So when we're talking about something that, the rate of inflation, right? It might be something that we've heard of before, the rate of inflation. What we're really talking about there is the annual percentage change, so the yearly percentage, and then remember this triangle means change. So the yearly percentage change in what? In the price level. So, every single year we have different CPIs for each particular year. Year CPI. So in 2012, the CPI was 2.3. In 2013, the CPI was 2.33. In 2014, the CPI was 2.37. So it's growing, right? That's the tendency. Inflation tends to be positive, right? The price level tends to increase. So when we're asking what's the inflation in year 2013, how would we calculate something like that? It's literally just the percentage change in the CPI from 2013 to 2012. So it's just any kind of percentage change, right? Percentage change, it's going to be the new minus old over old times 100. All right, this is standard arithmetic kind of stuff. So to get the inflation rate, the percentage change of these CPIs, the new price level, the 2013 price level is 2.33. We subtract 2.30 from that. We divide by 2.30, and then we multiply that whole thing by 100 to get a percent. So we end up seeing that this in the parentheses ends up being 0.0139. When we multiply that by 100, we end up with a inflation rate of 1.39%. And again, this is the inflation rate for 2013. So it's very important for us to be specific over what period of time. So, in the recent past, right, we've seen a lot of very tepid growth, right? The CPI didn't change at all from 2014 to 15, and it didn't change much from 2015 to 2016. But this was not always the way. This is, the result of a healthy economy and good monetary policy, so on and so forth, right? So let's take a look at an unhealthy situation, right? So when we think of an unhealthy economic situation, what comes to mind? The Great Depression. So during the Great Depression, right, if we look at that same kind of thing, year, CPI, and the inflation rate. So this started in 1929, lasted about 10 years. And we see the CPI started out at 0.171 and then went down to 0.167. So we had negative 2.3% inflation. The prices went down. And then in 1931, the price level went to 0.152. So again, it went down by 9% now. From 1931 to 1932, the new price level is 0.137. So again, that's another 9.9%, right? So we can have falling prices as well. When inflation rates are negative, we call that deflation. Any question on calculating inflation from CPI? That will be something you'll be asked to do in the quizzes on the midterm, so make sure that's something that you can do on your own. So when we're talking about economic data, a lot of times we're given the data in terms of the current dollar value, right? So if we're told something about, you know, the earnings in, you know, 1997, it's usually in 1997 dollars, right? Think about our earnings right now, you know, our 2021 earnings, we think of them as in 2021 dollars. So, you know, this is nominal quantity, right? So a nominal quantity is measured in terms of the current dollar value. Whereas a real quantity is measured in physical terms How is it measured in physical terms? Well, because we've stripped out the price changes. We've stripped out So whenever we want to compare, if we want to do any kind of comparisons over time, we have to use real quantities. Well, how do we get to real quantities? Well, there's a process that we use called deflating. So deflating a nominal quantity will convert that to a real quantity. So how do we do that in exact terms? We're going to divide the nominal quantity by its price index. So let's go ahead and do an example. So we're asked a pretty simple question here. Seems like it would have a pretty simple answer. We're asked, can a family buy more? Can they enjoy more goods and services with $40,000 in 2010 or $44,000 in 2015? So the immediate answer that we want to give is obviously 44,000, right? 44,000 is greater than 40,000, but these are apples and oranges, right? These are nominal incomes. So we have to deflate the nominal income in both years to get the real income. So the step one is to deflate from nominal to real for both. Now, it just so happens that we're using 2010 here. 2010 is oftentimes our base, right? But, you know, we don't want to get used to that, okay? So let's go ahead and we'll make a little chart, dealio. We've got year, we've got nominal, we've got CPI, and then we've got real. And so we've got 2010 and 2015. Our nominal, we were told, is 40,000 and 44,000. Our CPI, we're going to use the CPI from the initial example that we did last Friday in class of 1.25 for 2015. So how do we calculate the real income? So go ahead and on your own, in the next minute, test yourself and calculate what's the real income for both 2010 and 2015. And answer yourself the question, can a family buy more in 2010 or more in 2015 with that higher nominal income? So the first one's easy. And I even left the instructions up here, right? We divide the nominal quantity by the price index. So we divide the nominal quantity by the price index. So the real is going to be 40,000 divided by 1.0. So it's going to be 40,000. Again, this is not always the case, but in a lot of the examples, just for simplicity, that's how it is, right? What about for the 2015 number? Well, again, we're going to a base of 2010. And so, and again, how do we do it? We divide the nominal quantity by its price index. So we take that 44,000 bucks, we divide it by 1.25, and what do we end up with? I saw some of you using your calculators. Good job, good job. Some of you don't care, which is interesting to me. And you end up with $35,200. So they cannot buy more with the $44,000 given what the price level did in those interim 5 years. Questions on how we did that, how we answered that question? Again, there's going to be questions like that on your quiz and in the midterm. So for the sake of time, essentially there's a similar thing that happens with your wages. So you have, an average wage or a nominal wage. It's like this is what your paycheck shows, right? And then there's a different CPI, and then you end up with a real wage. And so, a lot of times people will say, oh, back in my day, minimum wage was only this and everybody was fine. Yeah, well, the nominal wage was 3.40, but when we account for the price of things back then, right? So again, even if it's less than 1, how do we get the real wage? We divide the nominal by the price index. So we go 3.40 divided by 0.39. So the real wage of that 1970 $3.40 worker is $8.72. And there's a similar thing we can do when we're talking about, 2016 wages. So this is using, so I need to be more specific here. The base year here is 1982 to 84. So it's an old ass base year here. It's not the 2010 that we're used to. 1982 to 84. Wow, we can barely read that. So our nominal wage, let's say in 2016, we got paid $21.56 an hour, and the CPI is 2.4, again, because we're going, that's like 30 years in the past, right? So how do we get the real wage so that we can compare, and this is the real wage in 1982 to $84. So we take the nominal wage, 21.56, we divide it by 2.4, and we end up with $8.98. So not very different at all when we're looking at it in terms of $1982. And I mean, really, there's this great chart in the book that talks about how, the real wage has stayed pretty stagnant despite the nominal wage increasing. So when we look at wages, and we start at 1970 and go to 2015, the real wage has really stayed around, in between this $8 to $10 range, while the nominal one starts out around, $3 and goes all the way up, like I said, $22. So essentially, a lot of things that the government hands out, or even like contracts or wages that you might get, there's a practice called indexing that fits in with all the rest of this stuff. So indexing means that you're going to increase the nominal quantity each period by the percentage change of some specific price index. So to use some economic jargon terms, indexing prevents the purchasing power of the nominal quantity from being eroded by inflation. Because what does inflation do? Let's say that you get paid, $1,000 a month, like Social Security recipients or something like that, right? If that's not indexed, well, we just saw the fact that prices are increasing every year, and so it wouldn't be long before that $1,000 a month is not enough to cover those basic needs of those people that, paid into Social Security throughout their whole life. So as a result, Social Security indexes with the general price level. So an example of this, if prices increase by 3% in a given year, the Social Security recipients receive 3% more. And there's no, there's no congressional, no need for legislation or anything like that. It just happens. And like I said, this indexing, we normally see it as part of, government stuff, right? But it also shows up in labor contracts. All right, let's skip that. Let's talk a little bit about the minimum wage. A lot of us are familiar with the minimum wage. I know I was paid the minimum wage a lot growing up. We're going to pick brown because it sucks. The minimum wage. So there's individual state minimum wages, right? But we're really just going to talk about the national minimum wage here, right? Congress sets a national minimum wage. And when they set this, it's in nominal terms. So, as opposed to Social Security where there's no need for legislation, right? Any kind of increase to the minimum wage requires congressional action and therefore is super controversial. Indexing would simplify this so much. And it would be less controversial. It's just, who actually wants to be less controversial, right? So neither one of the parties is really into it, which is aggravating. And so essentially, and the book even says this, the reason why this is happening is because politicians appear to benefit from that debate. What's going on back there? But we have seen the minimum wage increase over time. So the minimum wage has increased 15 times. So between 1970 and 2008, it's been increased 15 times by different amounts. And when we actually index it and we look at the real minimum wage, the real minimum wage has decreased by about 1/3 during that same period. So despite the fact that there have been some increases, they've been too few and far between, and the actual purchasing power of the minimum wage has gone down by quite a bit. So there's a lot of bias. We're not going to talk about all of it for the sake of time, and you've all read the book. I know you've all read the book. So we'll talk about the important stuff, the CPI quality adjustment bias. So this is an important bias because the CPI only measures, it only tracks or measures changes in quantity, not improvements in quality, as I was alluding to earlier in the class. So, PCs these days with 20%, faster memory or 20% better graphics card or whatever, right? it has maybe a 20% higher price, but this is not the same PC as the old one, right? The old one with 20% less memory, the one that you're upgrading from. It's not the same PC. It's different. There's a reason why I upgraded with 20% less memory. So if we didn't make any adjustment, the PC sector's contribution to the CPI would be 20%, right? It'd be 1.20. So, adjusting for quality is very difficult. It's something that a lot of economists spend a lot of time trying to figure out and come up with, rigorous processes. But there's just some guesswork that's involved, right? We didn't have computers in 1970, or we didn't have desktop computers in 1970. And when we're comparing things over long periods of time, it's how many, Teslas is how many stagecoaches equals a Tesla or something, right? It's really becomes, apples to oranges. So, not only are there a lot of subjective differences, just think of how many goods and services we have, right? There's such a large number of goods and services for them to go through. And again, talking, new goods. What do we do with new goods? With something like a 3D printer, right? So there's no base here. There's no base year price for new inventions. So what's another bias? Another bias is the fact that the CPI is assuming that there's no substitution going on, right? So the CPI, so there's a fixed bias. Right? It uses a fixed basket of goods and services. And there might actually be some substitution, right? When, there's a good chance that if something becomes more expensive, something has a price increase, they're going to substitute for something else. So at the end of the day, prices are noisy. We talk about how prices are the market clear and everything like that, right? In economics, prices transmit information, not just about the cost of production, but also the value that buyers place on one additional unit. And so when we have inflation that's essentially static, in this communication, the buyers and sellers are confused. They can't tell whether or not, is it that the relative price of the good is increasing, or is it that inflation is increasing the price of this good and all others? So in order to figure this out, you have to gather information from market participant. It comes at a cost. And one of the things that we find in general is that, the response to changing prices is both tentative and slow. So, indexing really helps to avoid a lot of this stuff. So, we index our income taxes and specifically something called bracket creep. What's bracket creep? I thought you'd never ask. That is when a household is moved to a higher tax bracket due to nominal increases in wealth, but not real increases in wealth. Or nominal income, sorry. And we'll get into this later, but higher tax brackets have higher tax rates. And we all know higher tax rates means less money for us to consume, which is bad. Not all of the taxes are indexed, though, unfortunately. The capital depreciation tax is not indexed. And so, this encourages firms to buy capital goods. It allows them to deduct a share of it as a business expense. Simple example. We got a machine. It costs $1,000. It's got a lifespan of 10 years. So the capital depreciation for this what's called an allowance is $100 per year. Take the total value divided by the number of useful years. But the $100 in the first year is worth more than the $100 in year 10. Because why? Inflation has eroded the value of that $100. It's eroded the nominal value. So in generally, because of this, in times of high inflation, capital investment decreases. So a lot of us, we hold our savings, we hold our wealth, meager that it may be, in checking accounts and saving accounts, right? And so that's essentially we're holding it as cash. So if there's no inflation, the cash is going to hold its value over time. And we're always going to hold some cash for convenience, just for transactional purposes, right? Even if you become really wealthy and you end up having a lot of money tied up in stock markets or tied up in your business or something, you're still going to have cash, right? You got to pay your bills, you got to eat, you got to buy stuff, so on and so forth. But if inflation is high, then cash will lose its value over time. In a similar vein, unexpected inflation will actually redistribute wealth. So let's suppose, which is not a big supposition, that workers' salaries are not indexed. And let's also suppose that inflation is higher than anticipated. So what ends up happening because of both of these things? Well, the purchasing power of those salaries goes down. The employers gain, because also think about what are they're selling a final good and service, and what has happened, the higher inflation means that they're selling it at a higher price. So the employers gain at the expense of the workers. This is a zero-sum situation, right? It's either somebody gets screwed, either the workers or the employers. Similarly, unexpected high inflation will benefit borrowers at the expense of lenders. Right? Usually when you borrow money, it's a fixed amount. There's a nominal interest rate that you're paying. And so if the inflation rate is higher, then the dollars you're paying back are worth less than anticipated. And so essentially erratic inflation is bad. A lot of decisions have a long time horizon, a long planning horizon. And erratic inflation makes that planning risky. Inflation kind of going all the way up and down, just crazy inflation makes those decisions more risky. So think about retirement. You save too little and you live less well in the future. You save too much and you live less well now. So there's this estimated cost of your desired lifestyle. All right, guys, I am so close. So we'll pick up with hyperinflation in class. I'll go ahead and extend quiz 7. Just go ahead and do quiz 6, though. You guys have got all the material that you need for it. And if you guys have any questions, as always, email me and come to office hours. All right, have a great one. Thanks.